capital structure is the mix of debt and equity used to fund a company operation and growth. It affects financial stability, profitability, and market value. The goal is to find a balance that minimizes costs and maximizes shareholder value. Factors like business risk, firm size, and market condition influence this decision. Debt can be attractive due to the tax benefits, but too much can lead to financial distress. Understanding the risk of excessive debt and considering agency conflicts and tax benefits are the key. The pecking order and signaling hypothesis help prioritize financing sources and signal companies' financial health.
The cost of capital is a simple but powerful concept that helps companies decide if their investments are worth it. So, what is cost of capital? The cost of capital is the minimum return a company needs to earn on its investment. So, if they don't earn this, they cannot satisfy investors or cover their costs. Imagine you borrow 10,000 ringgit at a 5% interest rate to start a business. You need to earn at least 500 just to break even. So that's your cost of capital. So, why is it important? For a company, the cost of capital helps decide if a project will make or lose money. So, if a project earns less than the cost of capital, it's not worth it. So, how to calculate it? The formula is called weighted average cost of capital. While lower is the better. A lower cost of capital means cheaper financing, happy investor, and more growth opportunities. It's like getting a loan with a low interest rate. It saves money.
So, how do we determine the optimal capital structure? First, by balancing cost of capital. The optimal capital structure minimizing the WACC while maximizing the firm value. Debt is cheaper than equity due to the tax-deductible interest, but increase the financial distress risk with excessive use. In Malaysia, GLC like Tenaga Nasional Berhad leverage debt for stable cash flow and government banking, enjoying lower borrowing costs. SME facing higher costs and limited capital market access, and often rely on equity and retained earnings. Earning transparency. Earning transparency reduces information asymmetry, lowering the firm cost of capital by decreasing the equity risk premium and borrowing costs. It highlights that transparent firms often achieve lower capital costs. So, in Malaysia, listed companies on Bursa Malaysia comply with MFRS disclosure requirements. For instance, Public Bank Berhad's strong earning transparency supports its high credit rating and favorable financing terms while occupied firms' higher costs. Industry firm factors. So in Malaysia, capital structures varies by industry and firm specific. Tenaga Nasional Berhad leverage debt for infrastructure projects, benefiting from stable cash flow and tax advantage. In contrast, high-risk sector like startup prioritize equity as seen with Grab Malaysia reliance with venture capital before adopting debt. Larger firms like Sime Darby access favorable debt terms while smaller firms often rely on equity or short-term debt. So now we're moving on to the factors affecting the capital structure and its decision. So the first thing is profitability. Profitability significantly influenced by capital structure as profitable firm often relies on internal funds like retained earnings, which align with the pecking order theory. The trade-off theory suggests profitable firm will still use debt to benefit from its tax shield. For instance, highly profitable Malaysia firms such as Petronas prioritize retained earnings for capital expenditure, minimize financial risk, and maintaining the flexibility. So next is the liquidity. Liquidity is a firm's ability to meet short-term obligations and significantly influence capital structure decision. According to the pecking order theory, such firms avoid debt unless necessary. In Malaysia, companies like Nestle Malaysia Berhad efficiently manage liquidity, minimizing reliance on external financing and reflecting a negative relationship between liquidity and leverage. So next, we're moving on to the asset structure. So the firms with more tangible assets can use them as a collateral, reducing borrowing risk. It supports the trade-off theory, allowing higher debt capacity. The pecking order theory also suggests that tangible assets helps reduce information asymmetry. For example, the Naga National Berhad used its physical asset to secure long-term debt, highlighting the role of asset structure in the debt capacity. So, last but not least is business risk, which reflects the firm's income uncertainty, impact capital structure decision. High-risk firms like those in volatile industry, for example like oil, gas, and technology, prefers equity financing to avoid financial distress. Low-risk firms like the stable income tend to use more debt for leverage. In Malaysia, firms like Grab Malaysia in high-risk sector raise equity via venture capital due to the competitive and evolving nature in their industry.
Financial distress occurs when a company struggles to meet its financial obligations such as debt payments or operational costs. This can lead to severe outcomes like bankruptcy, liquidation, or major restructuring. It usually signals deeper internal issues but can also result from external pressure. The impact of financial distress goes beyond the company itself, affecting stakeholders such as employees, creditors, shareholders, and customers. It can also indicate broader economic issues such as recession or shift in consumer behavior. Recognizing distress early allows management to take proactive steps to mitigate the risk and improve recovery chances. There are two main causes of financial distress: internal and external factors. Internally, poor management decisions such as entering unprofitable markets or high debt level can create significant financial pressure. External factors like economic downturns can reduce consumer spending, impacting sales and cash flow. A good example of financial distress in Malaysia, which is Malaysia Airlines. The airline faced both internal challenges like operational inefficiencies and high costs, as well as external factors such as fluctuating fuel prices and exchange rates that worsen financial situation. In conclusion, financial distress affects not only the company but also its stakeholder and the economy. It's caused by a combination of internal inefficiencies and external economic pressure. Good management, strong governance, and proactive strategies are essential to manage distress, reduce its impact, and ensuring recovery and long-term growth. The integration of tax effects and financial distress impacts a company's financial decision, especially its capital structure. There are three key points of integration of tax effects. The first point is tax incentive for debt. Interest of debt is tax deductible, which encourages companies to use debt over equity. This offers tax benefits but can lead to too much debt. The second key point is financial distress risk. High debt makes a company vulnerable to financial distress, especially in economic downturns. If revenue falls, the company may struggle to meet obligations, risking bankruptcy. The third key point is capital structure trade-off. Companies must balance the tax benefits of debt with the risk of financial distress. Too much debt reduces financial flexibility and may increase risk. In conclusion, companies must carefully balance tax benefits and financial distress risk when deciding on their capital structure.
Agency cost of equity. Agency costs happen when manager and shareholder have different goals. Shareholder want the company to grow and make profit, but manager might focus on their own needs, like higher salary or fancy perks. Imagine a company, the shareholder want to invest in new technology to grow the business, but the CEO decide to spend money on luxury office instead. So, these three create agency of costs. First, monetary cost. Shareholders spend money on audits or report to check what the CEO is doing. Second, boarding cost. the CEO promises to take a performance-based bonus to show they care about the company growth. And third, residual losses. Even with checks, some money might still be wasted on decisions that don't help the businesses. So, why does it matter? Agency costs can hurt the company by, first, wasting money on unnecessary things, and second, make it more expensive to monitor or control manager. For example, in startup, if they get outside investor, the manager might focus on personal project instead of growing the company.
What is pecking order? Pecking order theory is one of the major concepts in corporate finance, which explains how firms order their sources of funds based on asymmetry of information. A firm prefers to first utilize their internal money, following by debt money, and finally equity financing. This hierarchy is a consequence of the fact that managers are likely to be better informed about your firm's financial situation than external investors. The first component of pecking order theory is internal funding. Internal financing is the money generated within businesses, mainly from internal profits. Through the approach, companies have this opportunity to reinvest their proceeds into their companies rather than trading. For example, if a software company makes a profit of $1 million, it can option to at $700,000 to invest in its development of a new product line instead of giving it to the shareholder. Second component of pecking order theory is external funding. For companies that are willing to raise money from sources other than their company, external finance is the main element. Normally, it is categorized into two main divisions, which is equity finance and debt financing. This sort of funding is structured for those businesses that require a huge amount of money that their internal resources are unable to provide.
The third element is debt funding. The process in which a company raises the required amount by taking a loan is called debt funding. If the company wants to raise money on a market that could be traded, it will sell bonds, and if it wants to raise money through the banking system, it will pledge assets. Each of these loan-raising strategies has its pros and cons. The business can determine its interest rate and bond price by using the market to raise capital.
Last but not least, for the component of pecking order theory is equity financing. One significant advantage of equity financing is that it carries no repayment obligation. Unlike debt financing, where company must make regular interest payment and repay the principal, equity financing allows businesses to use their cash flow for growth and operational needs without the burden of monthly loan repayment. What is signaling hypothesis? The signaling hypothesis is an economic theory that explains how individuals or organizations transfer information about their characteristics or goals whenever there is a situation where one party has more information than the other. Higher education in Malaysia has grown quickly in response to the increasing need for skilled workers across a range of industries, especially as the nation moves towards a knowledge-based economy. With the population of educational institutions, the number of graduates entering the labor market has grown dramatically. However, this also leads to a problem of over-education and management skills. According to a study, an estimated 18% of Malaysian employees are over-educated for their jobs, while 28% are under-educated, based on Journal Economy Malaysia 2014. This is in line with the signaling hypothesis, which aside from the reason for gaining knowledge, postulates that people want higher education to increase their employee and rise above the competition in the job market. This theory is well elaborated in the Malaysian banking industry. Most employees often tend to favor those graduates coming from respectable universities, whereby such credentials signal critical thinking and problem solving to the employees. This is clearly an indication that educational credentials are signal and influence employment decisions. Most graduates with specialized training or those emanating from technical professions are often sought because of their perceived ability to contribute to organization goals effectively by ResearchGate 2016.
To conclude, Managing a firm finances requires balancing costs to achieve an optimal capital structure, maximizing value while minimizing risk. The pecking order theory prioritizes internal funds, then debt for tax benefits, and equity as a last resort. Effective decisions build resilience, sustain investor confidence, and drive long-term growth.
How long is this going to take?
Internal funding.
Maximizing value while minimizing risk.
How?
What is
How is it recalculated?
Okay, angkat diri.
So what is pecking order?
Kira. Which explain how firm order.
So? Sini aku tak. Sekejap!
How?
Jangan tutup. Okay. So, how is it recalculated?
How is it to signal a company's financial health?
This theory is
Dah pusing ke
of
half muka dia jatuh.
with the population of educational institution, the number of graduates. With the population of educational institution, the number of graduates.
So, how do we determine the capital?
Last but not least is equity funding. One significant advantage of equity financing is its carry.